Hi everyone, this is Ken Shreve with Investors Business Daily. Welcome to the Level 2 Home Study Program. In this DVD set, you'll learn advanced market tracking techniques that will help you spot market tops and bottoms. You'll see in detail the specific fundamental analysis and chart reading methods used to find stocks with the greatest potential. And you'll also discover the steps to take to protect your gains by identifying warning signs early on. Let's start with the market timing section because the easiest time to make money is when the market's in an uptrend. Decades of IBD research has repeatedly shown that market bottoms look a lot alike. New market rallies have always been confirmed by a follow-through day, so let's take a look and see what one looks like. Once you learn how to recognize a follow-through day, you'll be able to maximize your returns by being in the right stocks at the right time. Let's start by taking a look at the anatomy of a follow-through day. Here's a look at the S&P 500 back in October 1998. Remember that a follow-through day is confirmation of a new market uptrend. No bull market has ever started without a follow-through day, so it's important to recognize when one occurs. That being said, not all follow-through days are going to work, but you always want to be aware when one occurs because, again, no bull market has ever started without a follow-through day. Again, the S&P 500 back in October 1998, the S&P 500 was on a sharp downtrend. The market was in correction mode. When you're looking for a follow-through day, you want to see day one of a rally attempt, and that's what you saw right here. The percentage gain doesn't matter on day one of a rally attempt, nor does the volume. You're just looking for any up day in the market. Look at what happened the very next day, though. The S&P 500 closed lower, and its intraday low undercut the prior low of day one of the rally attempt. So that automatically kills the rally attempt, and it's time to start looking for day one of a new rally attempt. The S&P 500 closed lower for 3 days in a row. Here was day one of a rally attempt right here. After you see day one of a rally attempt, then you want to start counting because follow-through days are going to occur on day 4 or later of the rally attempt. You really don't want to pay attention to day 2 or day 3 of a rally attempt because sometimes there can just be short covering going on, and that can give investors a false sense of security that the market is acting healthy, but it really isn't. So don't pay attention to what happens on day 2 or day 3. Look for a follow-through day on day 4 or later. And that's what happened. You had day 2 of the rally attempt, day 3. Day 4 is when you start looking for that follow-through day, and then day 5 right here is when the S&P 500 showed that sign of strength that you want to see at a market bottom. It made a big percentage gain in higher volume. That's another critical element of a follow-through day. You want to see volume pick up from the prior day's level. So big percentage gain. Typically a follow-through day, you want to see a percentage gain of 2% or more. Follow-through day should really give the feeling of unequivocal strength, not something that's on the fence with a 1.5 or 1.6% gain. You want to see a good, strong percentage gain and higher volume. And remember, this rally here would have been declared dead at some point if this low had been taken out, but it never was. You had the follow-through day right here, and it spawned a nice little rally. Remember one important tenet of follow-through days. Every bull market in Wall Street history started with a follow-through day, but not every follow-through day launches a new bull market. Follow-through days have a pretty good success rate, but the other key ingredient you need for a successful rally is plenty of stocks breaking out of bases, asserting leadership. Without that, a rally could take a while to develop. Now let's take a look at the Nasdaq's follow-through day in March 2003, which launched a new bull market. In March 2003, there was a powerful follow-through day on the Nasdaq. I wanted to take a look at the Nasdaq's action a little bit before then in October 2002 because you did have a follow-through day here. Here was day 1 of a rally attempt, and on day 4 of the rally attempt, you had a big percentage gain. This was on October 15th, 2002, that marked a nice little rally for the Nasdaq. Little 19% gain. This was an example of how a follow-through day can launch a tradable rally, not necessarily a new bull market, but this was a time where there was good money to be made in the market. Even though it was a fairly short rally, the Nasdaq did rally 19% to its high of 1521. Then look at what happened. The Nasdaq went into what we call 3 legs down, and the concept behind 3 legs down is when sellers are getting flushed out of the market. So the Nasdaq went back into correction mode here, more than likely killing the rally attempt. But you can see the low of 1327 was undercut over here. It hit a low of 1261. The fact that this low was taken out means that sellers were getting shaken out of the market. And then the NASDAQ put in a low here that just barely undercut the low of 1261. This type of action, 3 waves down, again, serves to shake out sellers in the market. Then it's time to start looking for day 1 of a rally attempt and see if you can get a follow-through day on day 4 or later. So this ended up being day 1 of a rally attempt. Here was day 2, day 3, and then day 4. You had a powerful move in the NASDAQ on day 4 of the rally attempt. This occurred specifically on March 17th, 2003. It jumped 3.9% in higher volume. So that was the follow-through day. Again, if this low right here had been taken out, the rally would have been declared dead. But big percentage gain in higher volume here. And you can see it took a little while for the market really to get going, but this was the sign to get back into the market and start looking for leading stocks to buy. You can see it launched a nice, powerful rally in March 2003. NASDAQ was up 55% in 45 weeks from the follow-through day. Market bottoms, 1998 NASDAQ bottom. We started off this market timing section by looking at the S&P 500's follow-through day on October 1998. Well, the NASDAQ was also acting strong at the time. Here, the market was clearly in trouble here. You can see it was in the throes of a correction. You actually did have a follow-through day right in this area here, a little bit before the October follow-through day. The follow-through day occurred on day 6. Again, here was day 1 of a rally attempt, day 2, 3, 4, 5, 6. Here was your big percentage gain in higher volume, and that did indeed launch a nice tradable rally. But NASDAQ goes into correction mode, a lot of professional selling in the market, still time to look for day 1 of a rally attempt, so let's see how that played out. Here's day 1 of the rally attempt for the NASDAQ in 1998, day 2, day 3. Remember, this low has not been taken out, so the rally attempt is still intact. Day 4, and then day 5. Big percentage gain in higher volume here. Notice that volume picks up from the prior session. And in this case, the NASDAQ closed lower the very next day, but that's not going to kill the rally attempt. You got your sign of strength right here, a 5th-day follow-through day. So the fact that the NASDAQ declined wasn't such a big deal. You can see volume was lower than the prior session. But then you get a distribution day. A distribution day is a heavier volume decline, and it is a sign of institutional selling. General rule that IBD follows is that when you get a follow-through day and you see a distribution day or heavier volume decline within a 3-day window after the initial follow-through day, our research shows that the rally is going to fail half the time. Okay, so the fact that the NASDAQ marked a distribution day 2 days after the follow-through day, that was a yellow flag that this rally may have some trouble. Okay, then what happened is that the NASDAQ did manage to rally a little bit higher, but then you had another distribution day right in this area here, a heavier volume decline, another decline in the NASDAQ and lower volume, and then a big percentage decline right here. So you've had 3 distribution days since the follow-through day in a fairly short amount of time. This rally is showing signs of weakness. A little rally attempt for the NASDAQ right here. And then finally, the NASDAQ ultimately takes out the low of day 1 of the rally attempt, so that kills the rally attempt. Again, follow-through days have flagged many market bottoms in the past, okay, but they, of course, don't have a 100% accuracy rate. Nothing does in the stock market. So the fact that this low was taken out officially killed the rally attempt. Start counting again, day 1 of the new rally attempt, day 2, day 3, day 4. You have a 4th-day follow-through day in higher volume. Remember, here was day 1 of the rally attempt, so you saw a follow-through day on day 4. If this low here was taken out at any point during the rally attempt, the rally would be declared dead. So you're not looking at the low of day 1 of the rally attempt, you're just looking at the prior low here. Right here. So you had a 4th-day follow-through day, and then look what happened. You had another sign of strength the very next day. So you had 2 follow-through days in a row, 2 big percentage gains in higher volume. This was a sign that the market could be ready to start a nice uptrend. And you can see what followed soon after. So 2 follow-through days in a row were a good sign of strength by the NASDAQ. Now remember, when you see a follow-through day, that's your clue to start looking for high-quality stocks to buy. There are some instances where you're going to get a follow-through day and leadership is not clearly defined yet. So you don't want to force the issue when you see a follow-through day and jump back into the market with reckless abandon and just buy any old stock. You want to make sure that there are plenty of stocks out there, fundamentally and technically healthy stocks that are poised to lead. When the NASDAQ and the S&P 500 followed through in October 1998, you can see all of the stocks at the time that were breaking out of bases to new high ground that ultimately turned in to be big market leaders. Charles Schwab was one of the first stocks out of the gate when the NASDAQ followed through in October 98. You see a lot of other tech stocks here: Sun Microsystems, AOL, eBay, PMC Sierra, Broadcom, Applied Micro Circuits. So there were plenty of stocks flexing their muscle at the time, and these are the types of stocks to target at the beginning of a new rally that's marked by a follow-through day. Fundamentally and technically healthy stocks, not stocks near lows, but stocks that are near new highs with top fundamentals that are breaking out of sound bases. And the next section of this home study, we're going to teach you how to recognize what a sound base looks like. So lots of leaders breaking out when the NASDAQ followed through in 98. That was a sign that the rally was going to have some steam. You see what the NASDAQ did, up 233% from the follow-through day over 73 weeks' time. So this was an opportunity to make quite a bit of money. NASDAQ ultimately topped right in this area here. 1974. Again, the purpose of showing you past follow-through days, some of you might say, well, why is looking at a market bottom in 1974, how is that going to help you? This is all about market precedent. Market bottoms actually do look a lot alike, whether it was in 1998, 1974, or any period of market history. Market bottoms have always been put in with a follow-through day. Now, here, stocks topped back in late 1972 here and went into a lengthy correction. You can see the S&P 500 in 1974 down 50% in 21 months. Now let's take a look. During this decline, right in this area here, again, a lot of professional selling, a lot of uncertainty in the market, and there were plenty of times where the market did notch a follow-through day, but it just didn't have any staying power because of all the uncertainty and the fact that institutions were basically net sellers of stock. So you had a little follow-through day right in this area here on day 4 of the rally attempt. You can see it just didn't have any staying power. So that's why you want to pay attention when you start nibbling at stocks in the early stages of a follow-through day. You have to keep in mind that it possibly might not work. So again, you don't want to just move all your chips in at the beginning of a new market uptrend. As you can see, the rally failed because this low was taken out here. Again, it was institutional selling. And then you had a little rally attempt right here. This was back in September 1974. You had day 1 of a rally attempt, another follow-through day here that ran into trouble. This low gets taken out. So just keep looking for follow-through days when the market's in the throes of a correction. Just keep looking for a follow-through day and see if it works. Now, here was day 1 of a rally attempt right here. Remember the 2 successive follow-through days that we saw on the NASDAQ back in 1998? Well, the same thing happened in 1974. You had 2 big percentage gains. Volume picked up each day, and that ultimately marked the start of a new market uptrend. See, it did take a little while for the market to get going. Here were your 2 follow-through days right here. Went into a little consolidation, but then the S&P 500 had a big breakout here in higher volume. Again, the fact that this low was never taken out, the rally was still intact during this whole time. You may not have been aggressively buying stocks because the uptrend was not clearly defined yet, but the fact that this low was never taken out meant that the rally was still intact. So you can see the S&P 500 in 1974 was up 30% in 6 months. Not a huge rally, but again, another opportunity. If you were looking at the right stocks, fundamentally and technically strong stocks, there were opportunities to make money. So now you know how to identify when stocks could be ready to start a new uptrend. But what about market tops? Do the major stock indexes flash warning signs that a correction could be right around the corner? You bet they do. It's all about recognizing when big investors start unloading stock. Okay, that takes us to our market tops section. Market tops are generally going to be put in when institutional investors start selling stock. It's really as simple as that. You're going to see a lot of heavier volume declines in the indexes. You're going to see leading stocks that led the rally start to roll over in heavy volume. So identifying market tops is really about understanding when institutions start selling stock. So let's take a look at the 3-year bear market. That really started in March of 2000. This was another situation where the market was just getting taken apart by institutional selling. There was a lot of excess in the market. The tech bubble burst in March, April of 2000. You can see the market did stage several rally attempts where you did see follow-through days, but again, they just really did not have much staying power as the market worked out the excess that was built up during the bull market of the 90s. Remember, a distribution day is a heavier volume decline. It's a sign of institutional selling, and when you see distribution days start to crop up after a follow-through day, it is a sign to start getting defensive. Remember, follow-through days can sometimes mark tradable rallies, so you may not see a huge market uptrend, but it might be a 2-3 month rally where things are working. Distribution days ultimately impede that market rally, and that's really what you had several times during 2000, 2003. See a lot of tradable rallies here. One here, you had a follow-through day. Distribution days got in the way of that rally. Lengthy downtrend, another tradable rally here, another one right here. Just too much professional selling in the market. And again, we went over the March 2003 follow-through day. Eventually, the NASDAQ was able to confirm a new rally right in this area here. Let's take a look and see how stocks topped in 2000, because IBD was right there in print telling investors that stocks were topping. And again, it was just recognizing when institutional investors were starting to sell stock. The first distribution day for the NASDAQ occurred on this day right here. You can see it touched a high right around 5,000. But you can see a heavier volume decline. So this was distribution day number 1. NASDAQ rallies, touches another high. Point 2 here really just highlights negative price action. What happened here was the NASDAQ went and hit another high, but you can see how it closed right at its session low and volume picked up. So when you see this type of price action, whether it's an individual stock or a major stock index, this is called churning. So you have heavy volume without further upside price progress. So you had a reversal where the NASDAQ closed near its low in higher volume, plus the fact that it closed mostly unchanged from the prior day. So that's called churning action, and it was negative price action. So you had a distribution day here, churning action here, another yellow flag. This was a lower volume decline. But then you had a big distribution day here. NASDAQ closes near its low. Volume picks up again. So you're seeing signs of institutional selling. 3 days of negative price action in the NASDAQ. Another decline here in lower volume. And you see the NASDAQ start to rally back. This is a lower volume decline here, not a distribution day. NASDAQ starts rallying back. So looks like it's going to test its prior high, but look at what's happened. It's rallying in weak volume. Okay, so volume is below average. There's really not much conviction behind the buying. So you had 3 days of negative price action here, and now a rally attempt in low volume. Again, the purpose of showing you what the NASDAQ did in 2000, this is not a case of hindsight being 20/20 or a rear view mirror look at the market. This is about recognizing what signs of weakness look like, because this is going to happen at some point in the future as well. So if you can learn to recognize abnormal or unhealthy price action in an index, you'll be able to lock in profits in stocks. So this weak volume rally here was a sign that the NASDAQ was running out of steam. Then you had another distribution day right here, another one the very next day. So just so many distribution days in the market. This was really reason enough to get out of the market here. We're still only talking in April, so there were signs to get out of the market. And a lot of investors reading the big picture had already started locking in profits in tech stocks that they had big profits in. because that's what the big picture column in IBD was saying. A lot of distribution going on in the market, time to get off margin, time to be getting defensive and locking in profits. Okay, so you just had a lot of distribution. You can see what it ultimately did to the NASDAQ. It forewarned of further weakness. Then the NASDAQ really started falling apart. So, recognizing market tops is understanding when institutions start selling stock, and that is seen in increasing distribution days. We talked about the fact that during a follow-through day, a lot of leading stocks are going to break out of bases. Well, when institutions start selling stock and stocks in the market begin the topping process, you're also going to see leading stocks start to roll over. So all these bull market leaders during the late 1990s started selling off in heavy volume. And this is just sort of a brief look at our model books. And we have model books of how these stocks topped, and all of these ticker symbols topped in heavy volume, and you can see they were doing it, not surprisingly, when the general market was topping. Again, the big picture was right there, telling readers when distribution days started cropping up in the indexes. Here you had a little tradable rally later in the year in 2000 that marked a nice little rally, nothing big, but then again distribution days start to make their presence felt, and you get another sell signal in the market because of heavy institutional selling. So it's just really important to read the big picture column every day in Investors Business Daily. It's just an objective, no-nonsense look at the market. When the market is up, it's generally going to tell you if big investors fueled the move. If the market is down, it's going to tell you the same thing. And it's also going to monitor the action in leading stocks in the market. Okay, let's take a look and see how stocks topped in 1998. Again, rear view mirror? No, it's about recognizing signs of institutional selling, so this will help you in the future when the next bull market starts and ultimately rolls over. You'll be able to recognize these signs of weakness. Okay, we went over the NASDAQ follow-through day, the S&P 500 follow-through day in mid-October 1998. Well, the NASDAQ eventually started showing topping signs. Again, starting with a reversal in heavier volume, distribution day number 1. Here was distribution day number 2, so you had 2 in 3 days' time. Here was another distribution day, so you have 3 in 6 trading sessions, signs that institutions are starting to sell stock. Distribution day number 4, you can see, nice uptrend here, signs of institutional selling, time to start getting defensive with stocks in your portfolio. Maybe not locking in full profits, but starting to take some money off the table. NASDAQ breaks through its 50-day moving average. That's his red line right here. The 50-day line is normally a key level of support, but it went underneath the 50-day moving average. Then you had another distribution day. So you can see what institutional selling looks like in the market. What happened was the NASDAQ went underneath its 50-day moving average. You had distribution day number 5 here. And look at how the NASDAQ tried to rally back above the 50-day line. What was once a level of support now turned into resistance. So this was key price action as well. The 50-day moving average actually turned into a ceiling for the NASDAQ, which was just yet another sign of technical weakness. Then the NASDAQ goes through its 200-day moving average, another distribution day. Notice the volume was really huge, much higher than any other former down day. NASDAQ ultimately goes down 33% in 12 weeks, so a nasty bear market. 1929, the stocks topped just the same. There's so much historical precedent to not only follow-through days marking the start of new market uptrends, but also how distribution days can mark and indexes top. See, in 1929, there were 5 distribution days right at the top here that ultimately sent the Dow much lower. So that concludes our market timing section. Just to conclude briefly, remember when the market is in correction, you always want to keep an eye out for a follow-through day. No bull market has ever started without a follow-through day, but keep in mind that not every follow-through day launches a new bull market. We showed you some examples where they don't work, but it's always important to recognize when the when at least one major index makes a big percentage gain in higher volume on day 4 or later of a rally attempt. Remember, after a follow-through day, you also want to make sure there are plenty of stocks out there. The market should be saying, okay, here are the stocks to buy. You'll see these stocks in plenty of IBD stock screens and stock screens at investors.com, but if leadership is sort of hard to identify when you see a follow-through day, that's a sign to proceed cautiously. When it comes to market tops, again, it's just about recognizing when institutional investors start selling stock. They're so dominant in the market, you always want to pay attention to institutional selling when it starts happening in the major stock indexes. Now let's shift our attention to technical analysis. Keep in mind that successful stock selection is about using both fundamental and technical analysis. Start by identifying stocks showing outstanding earnings and sales growth, then use a daily and weekly chart to find the right time to buy. IBD has decades of research that shows certain chart patterns repeat again and again. You'll learn how to recognize several chart patterns, including the cup with handle base, the double bottom base, and the flat base, just to name a few. But technical analysis is more than just identifying a pattern. It's also important to recognize elements of strength and support within the base. Let's get started.